Most people think they only lose money when markets fall or investments fail. But the truth is far more subtle. You can be losing money every single day without noticing it. This loss is quiet, invisible, and often ignored. It doesn't come from one big mistake, but from small habits repeated over time. These habits slowly drain your financial potential and prevent your money from growing the way it should. One of the biggest hidden losses comes from keeping money idle. When cash sits in low-interest accounts, it may feel safe, but it is quietly losing value. Inflation reduces purchasing power over time. This means that even if the number in your account stays the same, what that money can buy is constantly decreasing. Another invisible loss is not investing consistently. Many people wait for the right moment to start investing. While they wait, their money does nothing. Time is the most important factor in investing, and every day without investing is a missed opportunity for growth. Fees are another silent drain on wealth. Investment fees, transaction costs, and management charges may seem small, but over time they add up. These costs reduce your returns and slow down compounding, making a significant difference over the long term. Emotional decisions also cause daily losses. When investors react to fear or excitement, they often make poor choices. Selling during downturns or buying during hype leads to losses that could have been avoided with a disciplined approach. Another hidden issue is lifestyle inflation. As income increases, spending often increases as well. Instead of investing extra money, many people upgrade their lifestyle. This prevents wealth from growing and keeps them in a cycle of earning and spending. Another hidden loss comes from not reinvesting your returns. When you earn dividends, interest, or profits and spend them instead of reinvesting, you interrupt compounding. Over time, this dramatically reduces how much your money could have grown. Small reinvested gains can turn into large amounts, but only if you allow them to stay invested and keep working for you. Many people also lose money by trying to time the market. They wait for prices to drop before investing, hoping to buy at the perfect moment. In reality, this often leads to missed opportunities. Markets move unpredictably, and staying out of the market usually costs more than being consistently invested. Another daily loss comes from inconsistent investing habits. Some people invest only when they feel confident or when markets are rising. During uncertain times, they stop. This breaks momentum and weakens long-term growth. Consistency is far more important than perfect timing. Lack of diversification can also quietly reduce your wealth. When all your money is placed in one investment, your risk increases significantly. If that investment performs poorly, your entire portfolio suffers. Diversification protects your money and supports stable long-term growth. Ignoring inflation is one of the most common hidden losses. Even if your money appears stable, inflation reduces its real value every year. If your investments are not growing faster than inflation, you are effectively losing money without realizing it. Another factor is frequent trading. Many investors believe that being active will increase their returns. In reality, frequent buying and selling often leads to poor decisions and higher costs. Long-term investors who stay consistent tend to achieve better results. Lack of clear financial goals can also cause daily losses. Without a defined plan, money is spent or invested randomly. This reduces efficiency and makes it harder to build wealth over time. Clear goals provide direction and improve decision-making. Fear during market downturns leads to unnecessary losses. Investors who panic can sell during declines lock in losses and miss future recovery. Staying invested during difficult periods is essential for long-term growth. Greed during market highs causes overpaying. When prices rise quickly, many investors rush to buy without analysis. This increases risk and reduces potential returns. Discipline helps avoid these mistakes. Another issue is not increasing investments as income grows. When earnings rise, many people spend more instead of investing more. This slows wealth accumulation and limits long-term financial growth. Comparing yourself to others can lead to poor decisions. Seeing others succeed quickly may push you into risky investments. Staying focused on your own plan leads to better results. Overcomplicating investing strategies often leads to mistakes. Simple, consistent plans are easier to follow and usually produce better long-term outcomes. Another hidden loss comes from delaying action. Many people know they should invest, but they wait. They wait for more money, better conditions, or more knowledge. While they wait, their money does nothing. Time is lost, and compounding is delayed. Even small delays can have a large impact over years. Not having a system leads to inconsistency. When investing depends on mood or memory, contributions are often missed. A structured system ensures regular investing and removes emotional decisions. Without it, progress becomes unpredictable. Spending small amounts daily can create large losses over time. These expenses feel insignificant, but when added together, they reduce the amount available for investing. Redirecting even a small portion of daily spending can improve long-term financial outcomes. Ignoring risk management can damage your portfolio. Taking too much risk can lead to large losses, while avoiding risk completely limits growth. A balanced approach allows steady progress without exposing your money to unnecessary danger. Following the crowd is another costly mistake. Popular investments often attract attention after prices have already increased. Entering at this stage increases risk and reduces potential returns. Independent thinking is essential. Not reviewing your investments periodically can cause problems. Over time, portfolios can become unbalanced. Regular review helps maintain alignment with your goals and risk level. High fees quietly reduce your wealth. Even small percentage fees compound over time, significantly lowering your returns. Choosing low-cost investments helps preserve growth. Emotional reactions to news often lead to poor decisions. Headlines create urgency, but reacting to them rarely improves long-term results. Staying focused on your strategy is more effective. Stopping investments during downturns reduces future gains. Lower prices often present better opportunities, but many investors avoid them due to fear. Not reinvesting profits slows growth. Compounding only works when earnings are returned to investments. Spending them interrupts this process. Lack of patience prevents wealth from growing. Investors who expect fast results often quit too early, missing long-term gains. Relying on luck instead of strategy leads to inconsistent outcomes. Wealth is built through discipline, not chance. Not automating investments leads to missed opportunities. When investing depends on manual action, it is easy to forget or delay contributions. Automation ensures consistency and removes emotional hesitation. Over time, automatic investing builds discipline and strengthens long-term results without requiring constant effort. Unexpected income is often wasted instead of invested. Bonuses, gifts, or extra earnings can significantly boost long-term growth if invested. However, many people spend this money immediately, losing the opportunity to increase their portfolio and accelerate compounding. Ignoring long-term planning causes daily financial losses. Without a clear direction, decisions become random. Long-term planning helps prioritize investing and keeps your financial strategy aligned with future goals. Constantly switching strategies prevents growth. Each time you change your approach, you reset progress. Consistency is required for compounding to work effectively. Frequent changes create instability and reduce long-term results. Focusing too much on short-term performance creates unnecessary stress. Daily market movements are unpredictable and often irrelevant to long-term success. Reacting to them leads to poor decisions and reduced returns. Lack of discipline is one of the biggest hidden losses. Even the best strategy fails without consistent execution. Discipline ensures that investing continues regardless of emotions or market conditions. Not understanding compounding limits your potential. Compounding allows money to grow exponentially, but only if given enough time and consistency. Without patience, its full power is never realized. Small habits have a huge impact over time. Saving and investing regularly, even in small amounts, builds momentum. Ignoring these habits prevents long-term growth and financial progress. Seeking quick gains often leads to losses. High-risk opportunities may promise fast returns, but they usually come with significant risk. Sustainable wealth is built slowly and steadily. Quitting too early stops progress completely. Many investors abandon their strategy before results become visible. Staying consistent is essential to reaching meaningful outcomes. Not adapting gradually can cause instability. While consistency is important, small adjustments help maintain balance. Ignoring changes in income or goals can reduce effectiveness. Expecting fast results leads to disappointment. Investing is a long-term process, and those who expect quick success often give up too soon. Comparing results with others creates pressure and leads to poor decisions. Every investor has a different path. Staying focused on your own strategy is key. Fear of making mistakes prevents action. Some investors avoid investing entirely, losing valuable time. Taking action is necessary for growth. Overreacting to market changes leads to unnecessary losses. Staying calm and following a plan improves results. Not increasing investments over time slows growth. As income grows, investments should grow as well. The real difference comes from behavior. Discipline and consistency build wealth, while emotional decisions destroy it. You are losing money every day not from one big mistake, but from many small ones. Fixing these habits allows your money to finally grow and work for you.